The vaults beneath Lower Manhattan hold a secret that most investors never contemplate. In the temperature-controlled chambers of the COMEX depositories, stacked pallets of silver bars represent the physical foundation market that trades billions of dollars in contracts every week. Yet, if you were to count every single ounce designated as registered, meaning actually available for delivery against futures contracts, you would find approximately 90 million ounces. At current market prices hovering near $30 per ounce, this entire stockpile represents less than $3 billion in value. To put this in perspective, that amount of capital changes hands in the silver futures market in a matter of days, sometimes hours during periods of volatility. This disparity between physical inventory and paper trading volume reveals something fundamental about modern commodity markets. They operate on a principle that banking systems have employed for centuries: fractional reserves. Just as banks discovered they could lend out multiples of their actual deposits because not all customers withdraw simultaneously, commodity exchanges function on the assumption that most contract holders will accept cash settlement rather than demand physical delivery. The system works beautifully until the moment it doesn't. Understanding architecture of this market requires grasping a crucial technical distinction that separates registered from eligible inventory. Walk into any COMEX's approved vault, and you'll find silver divided into these two categories. Eligible inventory consists of bars that meet exchange specifications for weight, purity, and form. They're stored in approved facilities, but they haven't designated them for delivery against futures contracts. Think of this as silver sitting in a safety deposit box. The metal exists, it's accounted for, but it's not available for someone holding a futures contract to claim. Registered inventory, by contrast, has been specifically warranted for delivery. The owner has completed the paperwork, paid the fees, and made that available to fulfill contract obligations. This distinction matters enormously because only registered inventory backs the delivery mechanism that gives futures contracts their connection to physical reality. When traders see reports of 300 million ounces in COMEX vaults, they might assume that represents available supply. But subtract the eligible portion and the ASII picture transforms dramatically. That 90 million ounces of registered inventory suddenly looks less like an abundant stockpile and more like a thin buffer between normal market operations and potential disruption. The mathematics of leverage in silver futures creates a structure that would make any nervous. Each futures contract represents 5,000 ounces of silver. With 90 million ounces registered, that's enough to cover 18,000 contracts if every holder demanded delivery. Yet open interest, the total number of outstanding contracts, regularly exceeds 150,000. The ratio fluctuates, but the fundamental reality persists. Paper claims on silver vastly exceed the physical metal designated to satisfy those claims. History offers instructive lessons about what happens when this ratio comes under stress. In January 1980, the Hunt brothers of Texas, having accumulated massive silver positions through both physical purchases and futures contracts, pushed the price from $11 to nearly $50 per ounce in a matter of weeks. Their strategy relied on taking delivery of physical metal, draining exchange inventories, and forcing short sellers into an impossible squeeze. The exchanges responded by changing the rules mid-game, implementing Silver Rule 7, which prohibited new long positions and allowed only liquidation trading. The price collapsed, the Hunts faced financial ruin, but the episode demonstrated both system and the willingness of exchanges to alter rules when stability was threatened. 3 decades later, in April 2011, silver experienced another dramatic surge, climbing from $30 to nearly $50 in a matter of weeks. This time, the catalyst wasn't a coordinated corner, but a confluence of factors: quant banks, concerns about currency debasement, and growing retail investment demand. The CME Group responded with 5 margin requirement increases in 8 days, raising the capital needed to hold positions from roughly $9,000 per contract to over $20,000. The effect was immediate and brutal, 30% in 4 days. Once again, the exchange had demonstrated its power to cool overheated markets through rule changes that effectively expelled leveraged speculators. More recently, the Reddit-driven silver squeeze of early 2021 revealed how quickly retail can impact physical markets, even when futures prices remain relatively stable. Investors flooded dealers with orders for coins and bars, creating premiums of $8 to $10 per ounce above spot prices. Mints struggled to keep pace with demand. Delivery times stretched from days to weeks. Yet the futures market barely but a bizarre bifurcation where physical metal commanded prices far above paper contracts. The disconnect eventually narrowed as production caught up with demand. But the episode highlighted how thin the retail supply chain actually is, and how quickly premiums can explode when buyers insist on physical possession. These historical episodes illuminate the stress points in the silver market architecture. The first vulnerability emerges when delivery requests exceed registered inventory. Exchanges have several options in this scenario, none of them particularly appealing. They can allow the registered inventory to drain, hoping that eligible inventory converts or new supply arrives before the vault's empty. They can increase new long positions and encourage liquidation. They can impose position limits to prevent any single entity from accumulating excessive claims. In extreme circumstances, they can force cash settlement, essentially declaring that contracts will be satisfied with currency rather than metal. Each response creates ripple effects through the broader. Draining registered inventory sends a signal that physical demand exceeds paper supply, potentially attracting more buyers who see the squeeze developing. Increasing margin requirements forces leveraged speculators to either post more capital or liquidate positions, often triggering cascading sell-offs as traders hit stop-loss levels. Position limits prevent large players from accumulating dominant positions, but also reduce market liquidity and can drive determined buyers to over-the-counter markets where transparency disappears. Forced cash settlement destroys confidence in the delivery mechanism, potentially driving a permanent wedge between paper and physical prices. Vulnerability involves delivery delays that cascade through supply chains. Silver doesn't teleport from mines to refineries to vaults to end users. It moves through a complex logistics network involving shipping, customs, insurance, and quality. Verification. When demand surges, bottlenecks emerge. Refineries can only process so much ore per have limited capacity. Vault operators need time to verify, weigh, and document incoming metal. A delay at any point in this chain creates delays everywhere else. Industrial users who need silver for manufacturing suddenly find their suppliers unable to guarantee delivery dates. Premiums rise as buyers compete for available supply. The smooth functioning of just-in-time inventory systems breaks down. The third vulnerability centers on the growing premium gap between retail and wholesale markets. When investors can buy futures contracts at $30 per ounce but must pay $40 for physical coins, has broken in the price discovery mechanism. This spread represents more than transaction costs and dealer markups. It reflects a fundamental distrust of paper claims. Buyers willing to pay substantial premiums for physical possession are essentially declaring that they don't believe the futures represents true scarcity. If this premium persists and widens, it creates dangerous arbitrage opportunities. Traders might short futures while buying physical, betting that the gap will close. But if the gap continues widening, these positions become untenable, potentially forcing liquidation that ex-problem traders were trying to exploit. Silver occupies a unique position in commodity markets because it serves dual roles that can suddenly converge. As an industrial metal, it's essential for solar panels, electronics, medical applications, water purification, and emerging green technologies. Roughly half of annual silver production goes to industrial uses, creating baselinists, regardless of investment sentiment. As a monetary metal with thousands of years of history as currency, it attracts safe haven buying during periods of financial stress, currency debasement, or geopolitical uncertainty. These two demand streams normally operate independently, but during certain conditions, they can reinforce each other, creating demand surges that overwhelm supply. Consider a scenario where solar panel manufacturing accelerates globally as nations pursue renewable energy targets. This industrial demand alone could consume an additional 100 million ounces annually. Simultaneously, if inflation concerns drive investors toward precious metals, investment demand might add another 100 million ounces of annual buying. Global silver mine production totals roughly 800 million ounces per year, with another 200 million from recycling. Adding 200 million ounces of new demand to a market of this size represents a 20% increase, enough to create serious supply deficits if production can't quickly expand. The psychology of market participants adds another layer of complexity to this analysis. Long-term stackers accumulate physical silver regardless of price, viewing it as insurance against monetary system failure rather than a trading vehicle. These buyers remove metal from circulation, creating a one-way flow out of available supply. Industrial hedgers need predictable supply months in advance, leading to lock-in purchases through forward contracts. Speculators trade momentum, piling into positions when prices rise and fleeing when trends reverse. Authorized participants in bullion banks maintain market liquidity by standing ready to buy or sell, but they manage risk carefully and will withdraw markets that become too volatile or one-sided. Each group responds differently to price signals and market stress. Stackers might accelerate buying during price dips, seeing bargains. Industrial users might panic buy to secure supply, ironically driving prices higher. Speculators might trigger losses and liquidate en masse during sharp moves. Bullion banks might widen bid-ask spreads or reduce position sizes, effectively withdrawing liquidity precisely when markets need it most. Understanding these behavioral patterns helps explain why silver markets can move so violently. The participants have fundamentally different objectives and risk tolerances. The sheer thinness of the silver market compared to other assets magnifies these dynamics. The entire global silver market, including all mining production, above-ground inventory, and financial products, represents perhaps $50 billion in total value. Gold, by comparison, is roughly 70 times larger. Major equity indices DW factors of hundreds. This small size means that relatively modest capital flows can move prices dramatically. $1 billion entering the silver market represents 2% of total value, enough to create significant price pressure. That same $1 billion in the gold market barely registers. In the S's, a rounding error. Several potential catalysts could trigger the kind of inventory depletion that tests market structure. A surge in the solar panel manufacturing driven by climate policies could add substantial industrial demand. Central banks, which have largely ignored silver while accumulating gold, might begin ifying into silver as a monetary reserve asset. Currency crises in major economies could drive safe haven demand from populations seeking to preserve purchasing power. A coordinated push by investors demanding physical delivery could overwhelm the fractional reserve system. Any of these catalysts alone might be manageable. Multiple asts converging simultaneously could create conditions that exceed the market's capacity to respond smoothly. The response mechanisms available to exchanges and market operators each carry consequences. Increasing margin requirements to 100% would eliminate leverage entirely, fundamentally changing the nature of futures from price discovery mechanisms to pure delivery vehicles. Position limits prevent manipulation, but also fragment liquidity and drive trading to less transparent venues. Delivery restrictions, or forced cash settlement, destroy the connection between paper and physical markets, potentially creating permanent bifurcation. Premium X-Blaws futures prices lag, create arbitrage opportunities that can destabilize both markets. Mining companies and refiners respond to price signals, but with significant lag times. Bringing new mines into production takes years, not months. The fundamental question underlying all of this analysis centers on price discovery. Does silver's value get determined by paper markets where supply is aesthetically infinite, limited only by margin requirements and exchange rules? Or does it get determined by physical markets where supply is constrained by geology, mining capacity, and refining throughput? For most of modern financial history, paper markets have dominated price discovery. Futures exchanges provide liquidity, transparency, and ease of trading that physical markets cannot match. But this dominance, joyar, confidence that paper claims can be converted to physical metal if needed, confidence that exchanges will honor delivery obligations, confidence that the system won't change rules arbitrarily. Confidence erosion in financial systems follows predictable patterns analogous to bank runs. The problem isn't absolute scarcity, but the fear of being depositors believe a bank has sufficient reserves. They don't withdraw simultaneously. But once doubt emerges, rational behavior shifts. Even if the bank has adequate assets, it cannot satisfy all depositors demanding immediate withdrawal because those assets aren't liquid. The same dynamic applies to silver if total silver inventory exceeds outstanding claims. If that inventory isn't designated as registered, or isn't in the right location, or isn't available at current prices, the system can seize up. Counterarguments to supply shortage scenarios deserve serious inventory can convert to registered relatively quickly if owners see profit opportunities. Mining production continues, adding new supply constantly. Industrial users maintain strategic reserves precisely to buffer against supply disruptions. Price increases naturally. Bring more supply to market as marginal mines become profitable and recycling accelerates. These factors provide genuine stability to the market and shouldn't be dismissed. Yet, lag times inherent in physical markets create vulnerabilities that financial markets don't face. Mines can't ramp production overnight. It takes months to years to expand operations. Refineries have fixed capacity constraints and can only process so much material per day. Transportation creates bottlenecks that money alone cannot immediately solve. Converting eligible to registered inventory requires paperwork, fees, and owner willingness. It's not automatic. Strategic reserves help industrial users, but don't add to market supply unless those users sell rather than consume their stockpiles. A market reset wouldn't necessarily involve overnight collapse. More likely would be gradual repricing as participants lose faith in paper mechanisms. This could manifest as persistent and widening premiums for physical metal over futures prices. It could involve exchanges restructuring to require full backing of contracts, fundamentally changing leverage rat bifurcated markets where paper and physical trade at substantially different prices for extended periods. It could result in industrial, users bypassing exchanges entirely, negotiating direct supply agreements with miners and refiners. The true risk isn't that silver disappears from the earth. Geological reserves remain substantial. The risk is that the pricing about what their contracts are worth and whether delivery will occur as expected. In functioning markets, prices provide information that coordinates behavior. They signal scarcity, attract supply, ration demand. When prices in paper markets diverge significantly from prices in physical markets, this information system fails. Buyers don't know where true clearing prices lie. Sellers don't know where to direct supply. The coordination mechanism that makes markets efficient dissolves into confusion. 90 million ounces of registered silver inventory represents either a comfortable buffer or the last thin line before a market structure built on leverage and trust faces its moment of truth. The answer depends entirely on what happens next, whether demand remains manageable, whether supply responds to price signals, whether confidence persists, whether rules stay stable. Markets exist in a state of dynamic equilibrium, constantly adjusting to new information and shifting conditions. That equilibrium can persist for years or decades, creating the illusion of permanence. But equilibria are not guarantees. They're temporary balances that hold only as long as underlying conditions support them. The silver market's fractional reserve structure has functioned for generations. Whether it continues functioning depends on variables that no single participant controls and that can shift with surprising speed when circumstances align.